Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTC QB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Eric Hadik, CEO and president of InsideTrack.com and InsideTrackTrading.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim.
Eric, what kind of pattern are you seeing setting up with the U.S. equities where you have 1 or 2 days of climbs and then another dramatic drop?
Well, I think that stair-step pattern that you discuss is certainly a good way to gauge what part of a trend you're in. And when you watched the equities from late August and then late September down into late December, what you saw was a progression of successively greater declines and successively lesser rebounds between each of those declines, which is what's characteristic of a trend. And one of those indications that you could tell when a trend is reaching its culmination is when the latest rebound, in this case we're talking about somewhere in the 1 to 2 week or 2 to 4 week basis, when that rebound is greater than the previous one. That's kind of one of those early warning signals that, okay, the trend is starting to turn. You're being able to maintain buying for a little bit longer and a little bit greater magnitude than in the past. And so it's one more kind of technical thing that reflects underlying fundamentals when you really understand what the charts are showing you. And I've seen more of that since that late December low in the equity markets. That certainly the rally since then was of greater magnitude than any of the rallies we had seen throughout the fourth quarter of last year, and the duration of this rebound has surpassed the duration of any of those preceding rebounds. So it's certainly confirming what I think a lot of traders are already seeing, that we've put in a bit more significant of a bottom back in late December.
Now, one of the questions people are asking is, have we seen enough of a bottoming out that the markets will start expanding or climbing again? I've got a specific trend indicator I use that kind of has it's multifaceted and gives me diverse conclusions drawn from it, and on a monthly basis, that indicator in late December gave me, first of all, it told me that it confirmed what some of the weekly charts were already showing me, that we should see a more significant bottom, meaning a bottom that holds longer than any of the preceding ones of the last 6 months. I would expect that bottom to hold for at least 2 to 3 months, potentially longer. But at the same time, what that indicator triggered at the end of December was confirmation of a larger scale reversal to the downside, excuse me, meaning that once we see the intervening rebound, it's a lagging and confirming indicator, and that oftentimes the bottom of a first leg down but at the same time, it reveals to you whether there should be another decline out on the horizon that takes out those lows. And in many of the indexes, that indicator said that yes, we should be seeing another leg down a little bit later in 2019. But one of the more interesting things, I often talk about the certain proxy stocks that I watch to help corroborate some of the cycles I'm watching, some of the indicators that are being triggered. And those stocks are some of the, most recently, some of the key ones that have made up a large portion of the gains in the overall market, stocks like Netflix and Microsoft and Apple. But the interesting thing to me was that several of those, while signaling that late December bottom, did not turn their major trend down. So they show that they should go back up and retest their highs. Those among them was Netflix, Google, I think Microsoft too, but not Apple. Apple did turn its longer term trend down. But what that's kind of showing me is we could see some wide trading range for the first 3 to 6 months of the year, where some of those stocks work back towards their highs, and the corresponding indexes would rebound but not retest their September-October highs. And then once that is seen, we see another leg down where some of those proxy stocks maybe do not violate their December lows, but yet the broader indexes do drop to new lows. So it would fulfill those indicators. It would kind of give you a corroboration to the longer term outlook. And so that indicator, by looking at it in several diverse stocks and indexes, kind of gives you an indication of what to expect. I've done several reports dating back to July of last year where Netflix has been such a great harbinger or omen of what's going on in the market and has had such a consistent cycles that have helped pinpoint its turning points. In fact, it's had an uncanny 15-week cycle that back in late November, early July, I had put out an alert saying it was fulfilling that. It had fulfilled back-to-back advances of equal magnitude, about $150 each rally, and it was preparing for a larger decline, even as the indexes were not yet ready to do the same. It topped the next week, and then, not surprisingly, during its next 15-week cycle, that was early October, when it set a lower high and several of the indexes retested their highs, and that ushered in a more bearish period. And then the latest phase of that 15-week cycle was last week when Netflix was expected to surge up to some key resistance and likely top above right around the 350 level. And it did just that and reinforced that 15-week cycle again. So you've got these diverse stocks and indexes that, when you put them all together, start to give you a clearer perspective on what to expect in the coming weeks and months.
We'll have more with Eric Hadik right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're speaking with Eric Hadik. Eric, what do you see happening in the gold market?
Gold, I still am going on the same premise that we set at least a 6 to 12 month bottom back in August and September of last year, that we should see an initial rally in January, which we've seen. There was such a synergy of upside targets and resistance levels from 1290 to 1300, and that's why I thought we would see a multi-month peak set at that level. And at the same time, silver was, I've discussed this range trading that silver has done for the last 5 years or so, where it stays confined in these very consistent $2.50 ranges, and most recently it had gotten down near the bottom of one, that is at $13.50 is the one parameter, and $16 at the other. And I was looking for silver to surge back up to that $16 level before it peaked in January. It got right up to that, and sure enough stopped on a dime right as it got to that level. So I think that both those metals have fulfilled their initial upside objectives, that we're in a corrective mode. I've discussed some downside targets that, if they're hit along with some key cycles coming up in the not too distant future, that would, I think, set up the potential for another buying opportunity. But I don't think we're there yet. I think we have more downside, and that this is all part of a larger magnitude bottoming process in gold and silver that is going to influence them through 2019 and 2020.
What's the position on oil?
Oil fulfilled so many major cycles in September, October of last year. For the last year or two, I've documented these 5 and 10 year cycles, and then this very consistent 15 to 17 week and 32 to 34 week cycle. And when they're oscillating at different rhythms, they don't have as much consistency, but they were all coming together in September, October of last year and projecting a major top. And I was also discussing the energy equity connection and how both of those were showing the fourth quarter as being a very bearish period. We've seen that play out, and I think that oil is going to really be stuck for quite some time now after fulfilling those major cycles last year. So I expect it to be more of a trading range for at least the first half of this year, and potentially longer.
We'll have more with Eric Hadik right after this.
I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZB. For more information, please visit us at powerbandsolutions.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Eric Hadik. Eric, what's the outlook for agricultural commodities?
I think that particularly the grains, that they're going through a slow bottoming process. And from a broader trend and cycle basis, I've been looking at 2020 as what I think will be the next significant peak in some of the grains, soybeans, corn. And so as we get closer to that time frame, and as long as this bottoming process continues and they start to show a little bit of that stair step you were talking about with stocks, except in this case it would be in grains on the way up. If they continue to trace out that type of pattern, I think you could have some good upside potential later this year, and then even more so in 2020. But when you look at markets like soybeans and even wheat, they've just got such a synergy of yearly and monthly cycles. In soybeans, those cycles range from a very consistent 4-year cycle, an 8-year cycle, something that's right around 16 years, as well as some monthly and some developing weekly cycles that all come into play in the middle part of 2020. And so that's kind of the lens through which I've been viewing what's going on in the grains right now, and am looking for a little bit bigger or larger degree buy signal to be triggered to start getting me more aggressive in getting on the long side of those grains.
What's the cycle look like for bonds?
For bonds?
Yes.
There is a pretty consistent longer-term cycles that are coming into play later this year, and ever since we topped in 2016, that's been my conclusion that bonds should head lower on balance into the second half of 2019. And, from a theoretical standpoint, all that would mean is that bonds would have to drop one tick lower than the low they've set up till now, at the end of, or in the second half of 2019 to fulfill that cycle. I'm not saying that's the case, but I'm trying to clarify. Anytime I talk about something like that, I'll often get readers or listeners that say, well, why isn't it just going straight down from 2016 to 2019? Well, that's not how markets work. It's not how trends work. And with these cycles, when I'm looking at those longer-term cycles, all they tell me in and of themselves is when to expect these final highs and final lows. Then it's up to a lot of other indicators in between there to specify your interim trends and the trading signals on both sides of the market. But I think that bonds could wait until the second half of this year to set a final low, which means we should see another leg down between first quarter and third quarter of this year.
Interest rates. What's your line on that? The European Central Bank today said that it wasn't going to hike rates and keep them at a record low at least through the summer. The Bank of Canada didn't hike rates last time out. Do we think the Fed will hike rates again this year, or are they going to hold pat?
Well, for the most part, that interest rate expectation and analysis is just the inverse of that for bonds and notes. And so that analysis for me that bonds could see one more leg down tells me by association that interest rates, or at least the expectation for interest rates, will probably revive that idea of one or two more rate hikes later on in the year. After that December hike, you had such a shift in what Powell was talking about, the Fed chairman, and the idea of letting the markets help determine future rate hikes, and several factors that suddenly had a lot of those expectations for more rate hikes just evaporate in the near term, I think that you'll see those expectations steadily build back up, particularly if what I was describing in the equity markets unfolds over the coming months, where we get some steady recovery. Doesn't mean that the stock market's going back into a new bull market, but if it just works its way higher for a few months and other economic indicators continue to corroborate that, you just had a 40 or 50 year low in jobless claims, I think it was this morning. You continue to get those positive economic numbers, and if the market stabilizes, then I think you're going to see that mindset come back into vogue, that we've got another rate hike or two left before this whole cycle is complete for the Fed. As for how that impacts European and Canadian, I couldn't really tell you. My focus is on the U.S. interest rate markets. But I do think that the expectation of another rate hike, which is really what drives those markets, is going to come back in the coming months.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrack.com and InsideTrackTrading.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet, our YouTube channel, Talk Digital Network. If you have any questions for Eric or any of our other guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.